You made money on the stock, but still ended up with a loss. How is that possible? Because return isn't just price. It's dividends, currency, and risk. Let's break the formula most candidates get wrong. Question 6. An investor buys a share for $85, receives a dividend of $1.50 during the holding period, and later sells the share for $78. What is the investor's total return? A negative 6.47%. B negative 7.06%. C negative 8.24%. Correct answer, A. Capital loss, selling price minus purchase price, resulting in a loss of $7. Dividend income, received $1.50 in dividends. Total return, a negative return of approximately negative 6.47%, indicating an overall loss. Question 5. A UK-based investor buys shares of a Japanese company directly on the Tokyo Stock Exchange. Over the holding period, the share price increases by 8% in yen terms, and the company pays a 2% dividend yield. However, the Japanese yen depreciates by 5% against the British pound during the same period. The investor's total return in British pounds is closest to 4.5%, B 10%, C 15%. Correct answer, A. Total return calculation combines yen-denominated return and currency depreciation. Yen-denominated return, 10% from 8% share price increase plus 2% dividend yield. Question 4. Which of the following statements about measuring the risk of equity securities is most accurate? Our risk is commonly measured by the standard deviation of past dividend payments, adjusted for inflation. B risk is typically estimated using the standard deviation of the security's historical total return. C risk can be fully captured by evaluating the volatility of earnings per share alone. Correct answer, B. In finance, the risk of an equity security is its volatility, which refers to how uncertain or variable its future returns might be. When you look at an investor's total return from a stock, it's made up of two main things. 1. Price appreciation, which is the increase or decrease in the stock's value. Think of it as capital gains or losses. 2. Dividend yield, which is the income you get from the stock in the form of dividends. By considering the total return, we get a complete picture of all the different ways the investor could end up. Standard deviation is a well-known way to understand how much things are changing. It tells us how much a security's past returns have varied from its typical return. If the standard deviation is high, it means the returns are all over the place, more volatile, which makes the investment seem riskier. In portfolio theory, it's the starting point for figuring out total risk, which includes both systematic and unsystematic risks. It's also used to help calculate other important things, like the Sharpe ratio and beta. A. Incorrect. Dividend yield is an inadequate measure of total return risk for stocks, as it excludes share price volatility and is often manipulated by management. C. Incorrect. Earnings per share, EPS volatility only captures business risk, not market risk, which is the risk of stock price fluctuations due to external factors. Question 3. Which of the following securities would most likely exhibit the lowest price volatility for an investor, all else equal? A. Non-cumulative callable preference shares. B. Cumulative non-putable preference shares. C. Cumulative putable preference shares. Correct answer, C. When it comes to the price swings in something like preference shares, which are similar to fixed income securities, it's mainly because we're not sure what the future will bring in terms of dividends and when we'll get our money back. Here are some features that can help keep the price from bouncing too much, which is good news for risk. Putable feature, downside price protection. This feature lets the investor sell their shares back to the company at a set price. Think of this as a safety net, keeping the price from going too low and helping to prevent big losses. This makes the security's price swings a bit less dramatic. Cumulative dividend feature, income certainty. This feature makes sure that if the company doesn't pay a preference dividend, those missed payments add up and need to be paid in full before they can give any dividends to common shareholders. This gives you a bit more peace of mind about getting the dividend income you expect, which can help lower the risk of not getting the cash you need. A. Incorrect. Non-cumulative and callable features increase risk and volatility for investors. B. Incorrect. Cumulative feature reduces risk, but non-putable feature increases volatility. Question 2. A firm has issued 3 equity securities: non-cumulative, non-putable, non-callable preference shares. Cumulative, callable preference shares. Common shares that pay no dividends. Which security is most likely to offer the highest expected return to investors? A. Non-cumulative, non-putable, non-callable preference shares. B. Cumulative, callable preference shares. C. Common shares that pay no dividends. Correct answer, C. We are really looking at which security poses the biggest risk and needs more money to compensate investors. Common shares that don't pay dividends tend to have the best potential return because they're not the first to get paid if the company runs into trouble compared to preference shares. They don't offer any guaranteed income, so the returns depend on how much the stock's value goes up. The total return is pretty unpredictable because it depends on how the market values the stock and how well the company is doing. They're dealing with the biggest swings in what they think they'll get in the future. So, investors need a higher return to make up for all that uncertainty and the fact that they're second in line. Since risk and expected return go hand in hand, the riskiest security should also pay the most. Preference shares usually don't offer the highest returns because they give you a set dividend, which makes your cash flow less unpredictable. They get paid first in dividends and when the company is liquidated. They're less risky than common shares. A. Incorrect. Non-cumulative preference shares are riskier than cumulative preference shares, but safer than common shares. B. Incorrect. Cumulative dividends reduce risk, while callable features limit upside. Expected return is lower than option A and common equity. Question 1. All else being equal, which of the following types of preference shares would be least risky for an investor? A. Non-cumulative callable preference shares. B. Cumulative putable preference shares. C. Non-cumulative non-callable preference shares. Correct answer, B. When it comes to the risk for preference shareholders, it really depends on how well they're protected from future cash flow issues and potential losses. The more safeguards the security has, the less uncertain things are and the less return you'll need to expect. Plus, if a company pays dividends over time, it helps smooth out income uncertainty. Just a heads up, even if a company doesn't pay dividends now, they still have to make up for any missed ones before common shareholders get anything. This makes dividend payments more dependable over time and shields the investor from potential dips in the issuer's profits. Putable rights act as a safety net. The investor has the option to buy back the shares from the company at a set price if things don't go as planned. This helps minimize the risk of losing money due to falling stock prices and makes it easier to get their money out. It also gives the investor more control and serves as a built-in way to exit the investment, acting like a built-in safety net. A. Incorrect. Non-cumulative dividends and callable shares increase investor risk. C. Incorrect. This option offers less risk than option A but carries higher income risk due to non-accumulating dividends. Lowest risk. Adding protections that can be taken advantage of boosts both your income and how much you can lose. Middle risk. Getting rid of call options is a good move, but if you miss out on dividends, it can still affect how stable your income is. Highest risk. Without dividend protection and the issuer having the right to call the stock, you're at risk of losing income and not seeing much in the way of price gains.